What's up, YouTube? Edgar here, and for all 2025, I'm gonna try to make weekly updates on my portfolio. So if you're interested, make sure to subscribe. And so let's get right into the update. Well, this past week I am down a significant amount, almost 20%, mostly from my Palantir position that I've been holding for a while now. Um, Something that I've learned is that I should probably take profits when I can on Palantir, and especially even on SoFi, because I believe that there was probably some two or three plays I could have done during the whole time I was holding these two positions. So I think next opportunity that I have, I will try to sell my Palantir position for sure to at least lock in some profits. Like I mentioned in my previous videos, I don't like the fact that one ETF, or not one ETF, one position holds so much weight on my portfolio, because if it, as you can see, the SPY, I believe, even though it is still in the red, it's not 20% down. I can tell you that. It is, for the past week, the SPY is down 2.08%, which isn't too bad compared to my portfolio, of course. So definitely going to look into some more diversification options. Another thing I wanted to talk about is I've been reinvesting some of my profits from all my other positions into SCHD and DGROW. I like the whole idea of dividend investing and being able to increase my income, especially in my taxable accounts, simply because, well, with the Roth and tax advantages accounts, you have to be certain ages, and you can't take out money without penalties and all those type of things. And if you want to retire early or earlier than possible, the best way to do it when it comes to investing in the stock market, I feel like, is through a taxable account, especially to avoid some of those fees that you can incur. So that's why I've been doing SCHD and DGROW. Those are two of my favorite dividend stock ETFs. Back when I started investing, or back when my Roth IRA a couple years ago, I was doing what's it called? Picking stocks and even though I did like the process, I just didn't like to have to worry about whether if ExxonMobil was down or stuff like that. So I just like the idea of ETFs. I don't mind paying a small fee to have somebody manage the fund. So, and the fees aren't even that expensive for these funds. It's 0.06 expense ratio, and DGROW's, I think, even less than that. I believe one of these two was less. Oh, 0.08, yeah. So it's not too bad when it comes to funds. They're still pretty low. And also, another thing that happened this week is I was able to do a Walmart put credit spread. I did sell it for 91, bought it back at 77, but looking back, I probably should have not done this one, simply because I didn't receive enough credit. My risk to reward ratio was really bad on this one. Even though, let me see, why did I choose it? I felt like Walmart had a good support level. I believe in Walmart in the long term, so there's that too. And let's see, what was I looking at here? I was looking at the 3 month. Yeah, so yeah, I bought it around this day right here, around somewhere here, and then sold it, or yeah, sold the credit spread back for like a 15% gain, I believe. What did it say? Something like that. Um, yeah, 15% gain, $14. And here's just some transaction history that I've had on my portfolio. Just mostly credit spreads. One debit spread that I accidentally did. I typically do not do debit spreads unless it's probably hedging on naked calls options or naked put options. But this portfolio is still not big enough to do stuff like that. So yeah, it's mostly been Palantir, Nvidia, one Walmart, QQQs. I like the Qs simply because they provide more volatility. More volatility means more premiums. And yeah, look at that. Most of these, I believe all of these have been wins, except for one QQQ loss right here, 63. I did do a call credit spread. The market was looking a little bit down, in my opinion, during that time, of the way I had analyzed it. But literally, the 2 days later, it went back up. And so I just completely decided to limit my losses on that, because I already knew that was going to be a loss. Instantly, I could tell. And then my Palantir one right here. Let's see. Oh, yeah, I did do a covered call in my Palantir, and I did lose $112 right there. But overall, I am in the green. I am almost $900, $910 locked in profits. Another thing I wanted to talk about today was, like I did mention, I am putting some of my money into SCHD and DGROW, but I've thought about high yield ETFs. For example, let's see, monthly income. My goal is to increase my income, That's what I want. I want to increase my income with this portfolio. But in order to increase my income, I also need to increase my assets, like increase the value of my assets, so that eventually I want to be able to use margin, so that that margin can increase my income to later on increase my assets. That's a goal that I have probably further down the line. Like as soon as my account reaches like around 5,000, I'll try to dabble into some small margin, maybe even pay the Robinhood $5 fee, because with the $5 fee you get up to like $1,000. I know it's what, $1,000. Let's see. Well, when it comes, you'll essentially be paying $60 on $1,000 for the year. So it's what, like around 5-ish%, I believe. Let's see. Oh, there's no calculator here. See, 60 divided by 1,000 is what? Yeah, 6%, about 6%. So that it's basically a 6% loan. So I'm gonna see if it makes financial sense for me. And in order to increase my income, I was looking into high yield ETFs, like I mentioned, like Ymax. Ymax attracts me a lot, actually. The only issue with this is that the NAV does seem to go down over time. But I don't want to dedicate a good portion of my portfolio into Ymax. I would also like to do it into this other one that I have here in my watch list, the JP Morgan QQQ covered call one. That provides an average of what, 9-ish, 10% or yield. And I like this one because it allows for some capital appreciation. As you can see here, up for the year, it's up 10%. It's nothing like the QQQs that were up about 22, 23%, but still you get the additional benefit of some income coming in. So that allows your portfolio to also grow. And if you're like on a margin account, well, that means that the more valuable your portfolio is, the more you can afford to borrow. I'm not saying I want to borrow a lot, but if I need that option or something like that, that would be great. Because in the future, I also want to be able to do not covered calls, selling naked puts, because I feel like that's where you can make a lot of money. Naked puts is where it's at. It doesn't, you don't pay any interest on that when it's on margin. If anything could go wrong, just got to make sure that you roll it. Being able, in my opinion, it's best to sell like around the 45 days to expiration when it comes to naked puts. And so, yeah, I'm looking at those two. There's also the JP Morgan S&P, but the reason I want to do the JP Morgan QQQ is simply because it pays a little bit more, because the QQQs are more volatile, and with more volatility comes more premiums, like I've mentioned. And so Ymax is definitely something I've been interested in, just to allocate some part of my portfolio, because as you can see here, they pay weekly dividends. Let's see, dividend history right here. Let me see, does it show it here? Yeah, they started paying weekly dividends not too long ago, or like last year. And they were used to be a monthly, but look at that. They pay, like, just last payment was 13 cents. It's almost 14, 18, 24, 13, 12. And if I can properly allocate some assets into that, I know it'll probably be a depreciating asset. Hopefully it doesn't, or I can dollar cost average down and hope my yield on cost improves on that. But this is one of the funds that I've been looking at. And why Ymax is, well, Ymax is ETF of ETFs that the YieldMax company has. So let's see what's in Ymax. Let's see. Right here it tells you what the holdings of Ymax are. And overall, I'd say I like most of these holdings. I like. There's a few that I'm not too thrilled about to be included in this fund, but overall, let's see, Airbnb, I'm okay with that. AI, I'm okay. AMD, I'm iffy on that. Well, Amazon, I like. Apple, I like. Baba, Coinbase, I like. Disney, it's okay. Meta, I like. Gold, I like. Google, I like. JP Morgan, I like. Myrna, it's okay. Microsoft, I like. MSTR, I like the idea of doing covered calls in MSTR just because it has high premiums, but I don't necessarily believe in MSTR. As you can see, I like the Bitcoin one better. If I were to choose just one, I would take off MSTR and keep the Bitcoin one. The rest of these I like for the most part. Palantir I love, Tesla I like, ExxonMobil, Square. Like these are, I like overall the positions that they have on this. So it's definitely something I'll be interested in doing once my account does improve, or hopefully come back to its not all-time highs, but around the $5,000 mark. I'll definitely try to limit my calls or buying calls to just one for this portfolio, because this SoFi one is also killing me. I'm down a significant amount on this one. When it comes to percent wise, let's see, total percent change. Yeah, I'm down 20% on that. Even though I'm up on my Palantir one, I was up even higher. So yeah, so right now, let's see what happened to Palantir. I was up on Palantir, but let's see. I did have Palantir here. Yeah, Palantir is down to like $67 right now, $67. It seems to have found some support. And see, if I would have sold up here, I still believe in Palantir long term. If I would have sold up here my call and logged in about 1,500 in profit, I could have probably been back in another call or something like that. So definitely, I want to see if I can increase my number of plays by locking in profits and then trying to go back into the dips and seeing what else I could do, because I've seen some other positions. Like I could have done some positions on some other companies that were down as well. So yeah, tune in next week to see how my portfolio does, see if I recover from any of this. Definitely going to try to do more credit spreads. It's more risk defined. It doesn't create as much volatility. Overall for the year, or overall for my portfolio, it's still up like 40%, but it was higher. So there's that aspect to it. So thank you for listening and have a good day. Have a good week. Bye.